5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, what's up? This is Andrew from the Options Millionaire community, and today we're going to be diving deeper into the complete guide to volume price analysis by Anna Kohling. If you haven't already, please get yourself a copy of this book and read it cover to cover multiple times. I guarantee you it'll change your strategy for the better. And in this book today, we're going to be going over chapter 5, Building the Picture. Now in this chapter, there are 5 different categories that she discusses: accumulation, distribution, testing, selling climax, and buying climax. However, in this session, we're only going to be breaking down accumulation and the associated accumulation features. In the next video, we will be touching on distribution. Let's go ahead and get rolling. So what is accumulation? Accumulation is defined as the phase in which the market accumulates inventory at lower prices or value for the purposes of transacting the market much higher into premium. It tends to look a little something like this. Now what's actually happened here is that the large players are entering a campaign in which they need to accumulate inventory. Now Anna Kohling in the book gives a metaphor in which if you are a business owner and you are trying to start a marketing campaign to sell a certain type of inventory in your store, you certainly don't want to kick off that campaign and start advertising to the public if you don't have enough of the inventory in your stock to sell it. Because if people rush your stores to try to buy your stock and you have nothing, that would be catastrophic. It's the same way in the markets, is that the market is going to spend a period of time shaking out the sellers in the market to accumulate inventory in order to sustain a prolonged move to the upside. This is why we get periods of multiple days, weeks/months of consolidation style price action before we begin a bigger move. Now, if you're familiar with Wyckoff, this also falls in line with Wyckoff's second law of cause and effect, which means the longer the period of consolidation or accumulation, the bigger the move. The shorter the period, the smaller the move. Now, accumulation starts with a very strong campaign to sell off into a particular demand. Now, we don't necessarily know where this demand is. However, the best way to go about doing this is to look for levels of volume. If you see in this graphic that the campaign starts by aggressive selling and then peaks of volume to kind of slow down the market. This is where the buyers start to come in and hit and allows the market to slow down or stopping volume in order to enter the period of consolidation or, hopefully, accumulation. Now, this is where the market enters the shakeout phase, a prolonged period. It could be days, it could be weeks, it could be months of several periods of aggressive buying and selling. And every time the sellers bring it back down to the bottom of the range, the buyers hit under high volume to bring back up to the top of the volume. This is the shakeout phase. The purpose of this phase is to shake out any remaining sellers in this market so we can prepare to move higher. Now, it's also worth noting that this accumulation phase can happen across all and any time frames, all the way down to the 1-minute chart, and all the way up to the monthly chart. It all depends on the style of trade you are looking for. But when do we know when it's ready to break out of this accumulation phase and start going into the breakout/markup phase? When I am monitoring a long period of accumulation, I want to be looking for signs of what's called a buying climax. Now, the buying climaxes occur in the later half of the accumulation phases after a pretty good drawdown. Now, that drawdown most likely has been caused by some sort of fear event or catalyst or news event that creates a little bit of a windfall and fear selling in the market. And the market uses that opportunity for the one last sweep of aggressive buying that looks like an aggressive hammer candle on the particular time frame you are monitoring. We also want this accompanied by high volume. This shows that the buyers are aggressively buying and we're getting ready to start shifting to the high side of the range and then a potential breakout. So once we have the buying climax and we start to shift to the top of the range once again, we don't yet know if the market's going to break out or if it's going to reject like it did last time. Overall, the market needs to know when it's ready to go higher, because the worst possible thing that could happen is that they start this aggressive buying campaign back up to the top of the range and they get knocked down with aggressive high volume selling once again to come down to the bottom of the range, or even worst case scenario, new lows. That would be catastrophic for their efforts. So in order to know when the market is ready to go higher, they need to conduct what's called a low volume test. A low volume test is where the market transacts into an area of prior heavy selling for the purposes of seeking out any remaining sellers. Now, most likely, we will have a rejection of some sort at this area. However, it's the volume that is crucial there. If there's a rejection of high volume, that tells us there's still too many sellers left in this market and we need to continue the accumulation phase for a longer period of time to shake out any remaining sellers. If there's a low volume test, which means that we reject under lower volume or no spikes in volume, that tells us there's only very few remaining sellers left and we've pretty much done our job of shaking out all remaining sellers and we're ready to move the market higher now. Now, this example here on the chart is a textbook example of that. The market transacts higher into areas of prior historical selling, under low volume. We don't get any major spikes in volume. Now we know that it's ready to transact higher. Now, furthermore, it's even more confident for the buyers that we did not even transact back down to the range. They hammered it before after a little bit of selling. We have a low volume test confirmed, and now we're ready to break out. Now, this is a great textbook example of accumulation. If we zoom all the way out, we see that this accumulation phase resulted in about 800 points worth of climb from October 2022 until July of 2023. Now, identifying these accumulation rates can help you take a confident entry on the long side. When the market has a long period of accumulation and we finally do get the breakout, you know with confidence that the market is going to continue for some period of time. The market makers aren't going to accumulate for a long period of time and only make a small move. It would not be worth their time and effort to do that. It takes a lot of momentum and effort in buying and volume to get this market to move. Let's look at another period of accumulation. Now, this is a period here from December 2022 to January. This is after the prior accumulation breakout. We have another phase sell off into here and another period of accumulation. What we see here is the shakeout phase. This one lasts about 2 months. We have lots of bottom wicks, a lot of red candles, and an increasing volume here. But if you look closely, you can identify all the setups that we talked about. We have the buying climax candle here, which is an aggressive buy candle off the lower end of the range under the highest volume candle we've had throughout the whole range. This candle here would tell me we are getting ready to break out. And then we have the low volume tests. We have the breach up, we have the big sell-off candle as the sellers transact the areas of prior historical selling right here, and we have it under low volume. If this volume candle right here would have overtaken this one or have been something like this one or this one, that would have been high volume and I would not be willing to long this to the upside. I would be expecting this to come back down and retest the lower range once again. However, we had a nasty top wick under light volume. And then of course we see the buyer step in, hammer this move up, retrace back down to retest the prior resistance just like we saw over here, and off to the races. This is why when I successfully identify a period of accumulation, I leave these ranges on. I just extend them further out in time so I know when calculating my macro levels where the prior support resistance flips are. It helps me identify great places to go long or short depending on the cycle in the market. But that's pretty much the gist of accumulation. Understanding that the market is simply moving from accumulation to markup to distribution to markdown over and over and over again. That's all it is. You'll cut out the noise. You'll stop being fraught with fear on all major catalysts and be able to see what's actually happened behind the scenes. If you have any more questions, please let me know. Hit me up on the DMs in the Options Millionaire Discord channel. Come out and join us. We have fun every day. We are not a call out server. We are an education server. We go over this type of analysis every single day to help people. In addition, I've got a podcast on Spotify called the Making Millionaires Podcast. It's where we talk about all things related to emotional side of investing as well as technical setups. I appreciate you taking the time to watch this video. Until next time, I am Andrew with the Options Millionaire community, and I'm out. See ya!